Good afternoon, everyone. Can everyone hear me okay? Good? All right. Thank you. My name is Mike Dashner. I am the head of equity strategies, and I thank you all for coming. This is a Stonebridge annual economic forum. Dan Laufenberg is here, our chief economist. He's been the head of economic research with Stonebridge for 15 years now. Prior to Stonebridge, he was the chief economist for Ameriprise. And before that, Dan started his career with the Federal Reserve. So he's got a lot of experience both on the private sector as well as federal policy. So Dan is going to give his update. And then after that, Jon Lynn, he's the head of our fixed income department, is going to give an update on our fixed income strategy. I'll finalize everything with a quick note on the equity side. And then we're going to open everything up for a Q&A. So, with that said, Dan, thank you very much.
Thank you, everyone. I think apparently I was subconsciously not wanting to be here today because I drove to the wrong golf course. Yeah, so, and you'll understand why I might have been reluctant to come because if you were here last year, I was wrong. And so I have to confess, I thought for sure that we would have a recession last year. It didn't happen. So as a result, we're not going to have a recession this year either. How's that for forecasting? So let me start with, first of all, talk about last year a little bit. One of the things that really sort of drove my decision last year was the fact that I have a little model that I use that helps me try to pick turning points. Because in my view, the only time an economist can add value to a money management company is if they can pick turning points. If the economy is just going to go on in the way it normally goes on, we don't add any value. So I was trying to hopefully be on top of things and identify a turning point. It didn't happen. But I have this little model, and it said the model was telling me that we were approaching a turning point. But in the past, there were certain conditions that had to be in place before the turning point occurred. I was hesitant to believe my little model because of the pandemic. After the pandemic, we had this big rally and things, so the economy did really well. And I thought, well, that's probably the condition I normally get when this thing goes where it did. And so the turning point was just approaching very closely, very near. As it turned out, the model was right. The conditions that I needed for a turning point have in fact occurred. So now, here we are in 2024. My little model says that a turning point is approaching, but I don't have a recession in the forecast. So it never tells you exactly when, it just tells you it's about to happen. And so I think it's going to happen, but it's not this year. So in that respect, we probably will have a forecast that does reasonably well. The economy should grow at a fairly solid pace, not as fast as it did last year. If you recall, I thought the economy would do okay roughly in the first part of the year, but then fall into recession in the second half. This year, I think the economy is going to sort of move along at a good pace, a solid pace for the first 3 quarters of the year, probably a little bit of a slowdown in the fourth quarter, but it's not going to be a recession. There's no contraction. There's no recession in the forecast. In that particular scenario, last year we had the economy doing really well, I think for 2 reasons. One, we had disinflation throughout the year. Now, disinflation is inflation slowing down. And economists refer to that as disinflation. Prices are still going up, they're just not going up as fast. Disinflation. So we had that throughout the entire year. We had inflation go from something around 4-something to 3-something by the end of the year, depending on what measure you use. According to the measure that the Federal Reserve likes to use, it went from 4-something to 2.7-something. So it depends on what measure of inflation you're using. But we had this disinflation. At the same time, we had a labor market that stayed very, very tight. we had the unemployment rate basically go from 3.6% to 3.7%. 3.7% is a very low unemployment rate. Full employment by most definitions is if the unemployment rate is somewhere between 4.5 to 5. Here we've got an unemployment rate that's down to 3.7. Now the most recent one, the one in February, the unemployment rate jumped up to 3.9, and everybody said, oh, the labor market is finally starting to ease up. The tightness is starting to ease up. It's not as tight as it was. But that number can change again, and it probably will, and it'll probably go down in the next report. But the point is that the unemployment rate did, in fact, stay pretty low, and you had disinflation, which is the perfect conditions for the economy to do reasonably well and for markets to do well also. So that's sort of what we had last year. So what does it mean for this year? Unfortunately, not much. So I have to rely on my model again and on my own analysis, unfortunately for you. But I think this time I might have a better chance of being right. I think the economy is going to grow, but it's going to grow probably somewhere in the neighborhood of 2% over the first few quarters of the year, and then slow down to maybe about 1% in the fourth quarter. By then, I think the cumulative effect of inflation, because prices are high, prices aren't going to go down, prices are just not going to go up as fast, but they're still going to go up. And so the cumulative inflation pressures, the cumulative higher prices are going to start to weigh on consumers at some point. I found it rather interesting. You know that personal income, real personal income in January, real personal income, this is wages and salaries, transfer payments that you get, your Social Security checks, those kinds of things, interest income, rental income, all that's in personal income. Anything that's income is personal income, not capital gains, but just income. Personal income, adjusted for inflation, was up in January 0.7%. In 1 month, 0.7%. That's pretty impressive. That's, 8.5%, 9% at an annual rate for the year. If you take taxes out of personal income, if you do real disposable income, this is personal income after taxes, it was 0. So we paid a lot of taxes in January. And I'm trying to think what it was that we paid. Where were the taxes? Well, one of the side effects of higher prices is that you have higher taxes. You pay more. You pay more in sales tax. In fact, we had a few jurisdictions that raised their sales tax in addition to the higher price that you're already paying. You had real estate taxes go up because the value of your house probably went up over this time. So there's certain things. It's not necessarily income tax that accounted for this. It might have been all these other things like real estate taxes and sales tax. So just to remind you that it's not just inflation that can tax the consumer's income, it can also be tax. So, but the point is, I think they will have enough income because the taxes were sort of a one-off. In February, you didn't see that same increase in taxes. You had real disposable income still only, I think it actually was down 1/10 in February, so it was actually a decline. But I think you're going to see a real income continue to do reasonably well and allow the consumer to generate the wherewithal they need to spend. So I think the consumer still does okay, which is important for the economy because they account for a big part of the economy in the U.S. And so I think they'll be okay for a while, but probably not forever. Because one of the things that people are relying on is the Fed to eventually cut rates. And I think the Fed will cut rates at some point. The question is why? Why do they cut rates? The Fed said they're going to cut rates. I believe the Fed. I don't doubt them. They're going to cut rates. But why? Well, are they going to cut rates because inflation slows to below 2% and unemployment stays low? If they do that, then why are they cutting rates? If inflation is slowing down and unemployment isn't going up, why would I cut rates? What's my incentive? I run the risk of cutting too soon. I run the risk of going too far. I run the risk of any progress that I made getting inflation down going away, just reversing the process. Now, instead of inflation still going down to 2%, it might go back up again. It reaccelerates if I try to get too fancy. Maybe I just keep rates where they are if things are so well. But on the other hand, what happens if the Fed cuts rates because the economy is slowing down, if unemployment is starting to go up? What if they cut rates in that particular case? Well, that would be, I think, the more likely scenario where the Fed actually has a reason to cut rates and try to provide some stimulus to the economy. Not when things are going really well and inflation is low. You want to do it when things aren't going so very well, and we worry about inflation later. So anyhow, that's sort of, in fact, Jerome Powell, who is the chairman of the Federal Reserve Board, gave a speech yesterday. He had opening remarks at a forum at Stanford University. And he said that there were risks to the outlook. The Fed wasn't quite sure. He thought that the Fed would cut rates. I agree. He said they're going to. I think they will. But he said, we have to be careful. He said basically what I just said. He said, if we do it too soon or too much, we run the risk of inflation reaccelerating. If we wait too long to cut rates, the economy may actually retrench and unemployment goes up. So they're walking that very thin line. They're being very careful. They're trying to do it right. The Fed, I think, really appreciates their independence as a policymaker. I don't think they'll be pressured by any political group or other agency to do something other than what they think is the right thing to do. I was there for 14 years at the Federal Reserve Board. I just want to let you know, I was in the econometric and computer application section. Yeah, that doesn't exist anymore. I took it out of existence. When I left, they didn't need it. No, it was a group of people that managed their econometric model, this huge model of the United States. There were only 3 models available at that time. There was a model at the Wharton School called Wharton Econometrics. There was a model at the Sloan School at MIT called the DRI Econometrics, and then there was the Fed model. Wharton Econometrics and DRI Econometrics were 2 businesses that actually sold their forecasts to businesses. They were in the business of selling their forecasts. The Fed had a model, but we weren't allowed to tell anybody we had one. Because at that time, no one was supposed to know that the Fed even forecasted. But I want to let you know, that's changed, by the way. Now they tell you at every meeting what their forecast is. Or at least what do they call it? Not a consensus, but whatever. But any other, that's not it either. But they tell you that they're forecasting, and they tell you what it is. The point is that when I was there, we weren't allowed to tell anybody, but I wanted to tell you that the forecast was still being made. And one of the reasons they didn't want us to tell anybody that they were forecasting, because they thought if they got the forecast, they would know what the monetary policy assumptions were that were underlying the forecast. Because if you had the model, you could sort of backtrack out what you were assuming about monetary policy. And they didn't want anybody to have that information, right? Well, I was there for 14 years. I wasn't in that particular unit all that time, but I was there for 14 years. Not once did the Fed forecast a recession. Not once. We had 3. So I just want to remind you that the Fed is not infallible. They could be just as wrong as I was about the economy. So I think the economy is, going to do reasonably well. In that particular environment, inflation does, in fact, stay sort of sticky. That's sort of what I said it was going to do last year, but I thought it would stay sticky around 4.5%. This year, I think it's going to stay sticky around 3 to 3.2% is sort of where it's going to be. I'm talking about the CPI. I'm not talking about the PCE deflator or price index that the Fed likes to refer to. I have a nice chart that I brought along on a disk, but we decided we weren't going to use them, so I'm just going to tell you what happened. There's two of them. They both sort of move together, but they are different in some respects. You know, the broad moves are the same, but they're different. And one of the things that I find rather interesting is that on average, the difference for each month is about 0.3%. On an annualized, on a year-over-year basis, the difference between the CPI and the PCE is about 0.3%. More recently, it's broadened out to 0.9%. I'm not sure exactly why that has happened, other than maybe the weighting that they use in the various indices. But my inclination is that at some point that spread is going to start to narrow again. And so what you see is might see more of an improvement in the CPI than you will in the PCE. And so if the CPI, the consumer price index, if it sort of goes sideways, like I think, the PCE price index, the personal consumption expenditure price index, might actually start to drift up, and that gap will narrow again to right around 0.3–0.4%. So that'll be an interesting outcome if it does in fact happen. And it's the weighting. One of the things that you have to remember, it's not the only thing, but there's one big difference is for the personal consumption expenditures, it's all consumption expenditures regardless of who pays for it. So it's a price index of all expenditures regardless of who pays for it. In the CPI, it's an index of expenditures that you make out of your pocket. So it's what the consumer pays for. So the CPI is your expenditures. The PCE is the expenditures on consumer expenditures regardless of who paid for it. For example, Medicare, right? We get Medicare benefits. You pay a premium. That's your out-of-pocket expense and any deductibles and all the co-pays and all that stuff. But the part that is paid for by the government is still a consumer expenditure. It's still part of consumer expenditures in the national income and product accounts, except you're not paying for it. It's not included in the CPI. It is included in the PCE. So medical expenditures get a much bigger weight in the personal consumption expenditure index than it does in the CPI. Much bigger. And so when medical care costs are going up dramatically, it shows up in the PCE more so than it does in the CPI. Although the government tries to do its best to keep costs down, as we know. Except if you have to pay for it, it's a lot higher. So anyhow, that's one thing. The other thing is that, corporate earnings, we think are going to hold up reasonably well in this environment. We still have some inflation. We still have some growth in the economy, and so corporate earnings do okay. And so it's not that they are going to be gangbusters. We think they're going to be up for the year, 2024, but not as much as they were last year. Last year they were up around 8. S&P 500 earnings per share were up around 8 to 9%. This year they'll be 1 to 2%. So still positive, but just not as positive. So that's about the extent of the forecast. I don't have oil. If you want to know about oil prices are climbing. Obviously, this is a good example of a lot of the risks to the forecast and why it's so difficult to be decisive. Because you have things like oil price skyrocketing here in recent days. It's going to probably end up being a factor in the inflation story. So my 3% that I'm talking about in the second quarter might be a little higher, but then it's not necessarily going to stay there because, as you know, energy prices are very volatile and they could come down just as quickly. So that's all I have. Now it's Jon's turn. Jon Lynn's going to come up here and tell you what really is going on, because I have no clue.
Well, Dan, thank you very much for the great setup there. I really appreciate that. I'm going to be talking just a little bit about bonds and our bond strategy at Stonebridge. First, I think what I'm going to do is just give a little bit of historical context as to what rates have done here recently. Then I'll talk about where rates are currently, some of the risks that we see out there, as well as some of the opportunities. And then I'll just kind of wrap that up by talking about what our current strategy is, really kind of given all of the above that I'm going to be talking about. So if we look back to 2013, we may have seen the peak in interest rates at that time. We saw the 10-year Treasury touch 5%. We saw the 2-year Treasury touch around 5.20, and that was all towards the end of the third quarter. And then we saw a very dramatic rally into year end. And I'm going to be talking a lot about interest rates here, and primarily my focus is on government bonds. And I'm doing that just to kind of make things a little bit easier for everybody. I know most folks in the room are going to be invested in maybe corporate bonds, some treasuries, as well as municipal bonds. But really, as far as our strategy goes and the direction of interest rates, they're all very much intertwined. So as I mentioned, the rally that we saw into year end was really sharp, dramatic, and something we don't see very often in a 3-month period in the bond market. I like to say that we kind of saw equity-like returns there for a lot of sectors. Tax-exempt munis returned 9 to 10% in just that 3-month period alone. So really it's pretty incredible returns that we saw. Now most of that rally was driven by the market really anticipating or forecasting that we were going to see the Fed start to lower interest rates early on in 2024. And if you fast forward to the first quarter of 2024, that was really a period of adjustment for the market where the market started to perceive that we were really probably going to be looking at higher interest rates for a longer period of time. Cuts, as Dan pointed out, may not happen until later on in 2024. We are still living in an inverted interest rate environment, so that means that short-term interest rates are higher now on the short end than they are on the long end. If you look at the yieldiest part of the yield curve, you're looking at 3-month Treasury bills around, I think they're trading at about 5.25, 5.30 right now. So we are still inverted. Typically, when we look at an inverted interest rate environment, we're looking at, really about 1 year to 2 years in that environment. And right now, I think we inverted in July of 2022, so we're really sort of bumping up against the longer end of that range. Now, if Dan's not going to forecast exactly when the Fed is going to lower interest rates, I'm not sure I'm willing to stick my neck out and do the same. But what I will say is that eventually the yield curve will normalize. We're going to see short-term interest rates lower than long-term interest rates. You could see a couple of different scenarios of that playing out. You could see long-term interest rates moving higher or short-term rates moving lower or some combination thereof. I think that we feel it's more likely that we're going to see short-term interest rates lower than the long end raising, but you could see a combination of both. It, likely wouldn't be linear if you did. But I mention that because those are kind of where we see the risk and the opportunity in this market going forward for bonds. The long end of the curve is very flat, so moving from a 10-year Treasury to a 30-year Treasury, you're picking up about 15 basis points. And really, when you look at increasing your duration by 2 to 3 times, that's really adding a lot more risk for the yield pickup that you're going to get. So that helps to form kind of the strategy that we have on the fixed income side, which is really to focus mainly on maturities in the 3 to 7 to 8 year range. where you're really keeping your duration manageable. And when I say duration, we're talking about interest rate risk and the volatility that your bond portfolio will see as interest rates move. So if we are in that kind of shorter duration category, if interest rates start to come down, we'll see stabilized prices or actual increases in prices. The longer out you are, you're going to see a lot more volatility. So that's really kind of our strategy on the fixed income side right now. The last thing that I will mention is that it really wasn't that long ago that we were at very low interest rates. 4 years ago when COVID struck, if you looked at the 10-year back in the spring of 2020, we were at 0.75%. So if you look at 10-year yields right now, trading in the 435-ish, 440 range, that's still historically a very attractive rate. So we're not hesitant to extend our duration a little bit out to that 7 to 8 year range to really lock in those attractive rates for years to come and actually increase the income to fixed income portfolios. But historically, from a historic standpoint, we're still in a very attractive environment. So that's kind of our perspective on the fixed income markets. I'll let Mike talk about the equity markets.
So I've been working with Stonebridge for 15 years. Dan was hired just before I was. And for the first time in 15 years, I truly believe the fixed income market is more exciting than the equity market. And so I like to give the bond guys their day in the sun because it's unprecedented times, at least in the last decade and a half, right? And then when you take a look back, maybe we're getting a little more toward normalized rates when you look at it from a 30-year perspective. But it's great. It impacts. Once again, I find I spend all my day on the equity side, but we are focused on rates too. And in the broad scheme of things, the interest rate environment is what drives the equity environment for a number of factors, of course. So it's very exciting. And John, thank you very much. And I'm glad it's exciting to talk about bonds again. If you didn't notice, he said 4 years ago, the interest rate in the 10-year was below 1%. And so that pretty much was a non-story. I'm sure people remember the acronym TINA. There is no other alternative. And so for years and years and years, we built up our equity management side of the business because there just simply wasn't enough yield to make opening up new bond portfolios all that attractive for individual investors. Well, that's done. That's over. You can get above inflation rates on your fixed income portfolio now in investment grade credits, which is very, very exciting. So I've used up a good part of my equity talk now to discuss fixed income, and it's a very exciting time. I'm doing this in part because I promised myself that I was not going to talk about the Mag 7. But here I go. So, look, the equity market still is very, very interesting right now, and it has been exciting. In 2022, the S&P 500 was down 18%. In 2023, it rallied up 26%. And in the first quarter so far this year, the S&P was up another 10.5%. So as you can see, it's just getting whipsawed back and forth. And so I was thinking, and I was talking to my fellow colleagues in the last few days, what are we going to talk about? I want to switch it up. I want to relay what we're doing on the equity side. And we talked about returns. We talked about going into the weeds and what we're seeing differently. But really, when it all comes down to it, when our economic forecast is, we think it's going to continue to grow. We don't know when the correction is going to happen. There's going to be one. When the market in 1 year is down double digits and up double digits the next, we took a step back and said, since the post-war era, the younger folks in the room, World War II, there's been one way to really consistently make money in the equity market. And one, that's stay in, compounding returns. I think Charlie Munger said it was the eighth wonder of the world. But how do you stay in? And it's by owning quality. And it's the word quality. And I was thinking about it more and more and more. And what does that mean? And we can talk about it here in a second. But by owning quality, you get two things. You miss out on the nonsense stocks on the way up, meaning you avoid FOMO, and you keep from selling good stocks on the way down. And if you focus on quality and you can do those two things, you stay in the market long term. And if you stay in the market long term, you win. But again, it means owning quality. And that definition is difficult to nail down. It's real easy in hindsight. Oh, obviously that was a quality company, it's up. But when we say quality, it's very simple. We look for companies where we understand the goods and services that they provide. That's a no-brainer, right? But in 2007, there were a number of banks where I couldn't tell you what they did. The stock was going up. They were making a lot of money, but I couldn't tell you what they did. In 98, 99, a number of companies, once again, they're up 100% year over year. I couldn't tell you what they did. They were .coms. It was nonsense. They weren't real companies. So just that one barrier. Do you understand the goods and services a company does? All right, you just cleared the first hurdle. And then the second, we start sounding like bond analysts again, and I think that's a very powerful way of addressing the equity market. We look at balance sheet health. Is the company over-levered? If it is, all right, they're out of here. Big risk. If you have an unexpected economic downturn, will they make their bond payments? Oof. And remember, as an equity investor, we're last on the totem pole to get paid. So if their bonds go in default, ooh, that's a bad stock. And then we take a look at profitability, margins. Is there products and services? Does it have a moat? Is it defensive? Can anyone jump in their market? If those things all line up, you got yourself a quality company. And that's what we spend our time doing on the equity side, finding quality companies. And you'll notice, what did I not mention? I didn't mention price. Price is important, but price and valuation should be the last thing you look at. Brent Mellum taught me that, great mentor. When the price is too high or the chart's going up like this, you'll get tricked out of buying a real good company. And when valuations look really, really attractive, ooh, that PE is so small, you can get tricked into buying a bad company. So start with the story, start with the fundamentals, get to know the company. And then lastly, we look at price and set our price targets, find an entry point. But the most important part is knowing what the company does. Then you won't be surprised. You won't be surprised if in 1999, 2000, everything blew up and you found yourself, oh, I was totally invested in the NASDAQ and half those companies weren't even real, they didn't make money. We hope to never be in that situation again. And so, long story short, own quality. And again, that definition can move as time goes. But that's the one thing. That's the one thing that's been consistent. It's been the one thing where you can consistently make money year over year and maximize your long-term return. So that's what we're trying to do at Stonebridge. We do run several strategies. So we have a growth strategy, growth and income strategy, and a dividend income strategy. And those are really along the risk paradigm, right? The growthy strategies are for folks that can have a little more risk in their portfolios, and then so on and so on. So at the end of the day, it is very much risk targeting. But that's what we do, and that's what we're going to continue to do going forward, regardless what the macro outlook is. We do value Dan's macro outlook because that helps us shape the expectations we have of our companies. And so we want to have a really good idea of what's going on in the landscape, because then we can set our expectations on how we think our underlying companies can perform. So I wish there was more magic behind the scenes, but that's really it. That's what we do on a daily basis. It's a lot of hard work. It's a lot of fun work, and we enjoy what we do. But I would really like to use this opportunity to broaden up or bring up the Q&A. And if you have any questions on the equity side, fixed income side, or Dan's economic presentation, please feel free. Katya has a microphone. And if you raise your hand if you have a question, just hang out just for a second. She'll bring you the microphone. That way, I don't have to repeat it for the folks listening at home. And folks that are live streaming, please submit your questions online, and we'll try to get to everyone we can. Katya, is that okay if we start the Q&A?
Yeah.
I will point out I didn't get a round of applause like you guys did when they got done with that. Hey, thank you. Please clap. Thank you so much. Do you have a question? Okay, just give me 1 second.
I've been a value guy my whole life, but it's really stunk for 10 years. So in this environment, do you think that we could see a transition from growth leading everything to value?
Yes, we could. I've been calling one for 5 years, and it hasn't happened. But that's not really fair either, right? In 2022, it did happen. We saw an exchange from growth to value in a big way, but it wasn't sustained. I personally do think we're due for it, but there's no rule that says we have to. Historically, they do intersect.
A follow-up then. So, with the cost of money being below Treasury bond rates after inflation, with so much liquidity and so cheap a cost of money, is there any chance that value will beat growth?
That's a great question. I would like to answer that in one part, and if you have any follow-up, I would like to hear that too. My first instinct there is a lot of money out there still. And, we haven't seen, Powell said there will be pain. A year and a half ago, when they started to increase rates, there will be pain. And what did that mean? It meant we have to choke out some of the excess liquidity. And so there's still a lot of free money out there in companies that aren't posting real profits, but they're getting rewarded. As a fundamental investor, I do not like to see that. If I own stock in those companies, I'd say let's keep it rolling. But that's not the case. Dan, do you have an update?
Well, one of the areas that I was referencing earlier today, actually, or today or yesterday, was commercial real estate. It was sort of an interesting little note. With higher interest rates, a lot of the commercial real estate properties are having a difficult time renewing their loans at a rate that was as attractive as the one that they had before. It's not, instead of a 3% loan, it's now a 6 or 7% loan that they have to do. And I was listening to a commercial real estate guy, and he said, well, there's 20% vacancy rate right now. And I'm not sure what he was referring to, if he's referring to the entire U.S. But he said that 20% of real estate is there's no rent. And so renewing loans on that property is going to be extremely difficult at any rate. But he said that they probably won't ever be rented again because they're obsolete. And the buildings actually probably should be torn down and a new building built if you want it. It said rents are still going up on commercial property, but it's at the high end that the rents are going up. At those properties that really can't find tenants, there's no rent, and there's probably not going to be any renters for a long time, if ever. And so, how long do you keep that on the books until you decide that you have to let go? So that's an interesting little twist that I hadn't really thought about. And the other one was, no, we won't go there.
Next question. We did that good. Sir.
Your comment about 99, 2000, 2001, if you go back into the 80s, there were similar things. You would talk about real estate, but also technology back to the Magnificent Seven was leading several periods over the last 40 years. Do you think there's a chance that especially you're seeing kind of the upswing in investment, or at least talk about AI, that we could be looking at a similar kind of enthusiasm followed by a downward trend?
Great question. The answer is yes, it's possible. But we're in early stages of AI. And let's be fair. Information technology and communication services is the largest area of our economy. And technology has been leading the way since the Industrial Revolution in this country. And really, from the time we left the caves. And so it's understandable that the area where we all want to invest and we all want to pile into is information technology, is the tech space. And it always will be that way. Now, the question is, have we gotten ahead of ourselves? I think in some instances, possibly. And so how Stonebridge addresses it, some folks around are going to start rolling their eyes because I use this analogy all the time. I don't want to invest in the gold rush. I want to be the Levi Strauss of the gold rush. So and everyone who doesn't know, Levi Strauss didn't mine the gold. He sold the blue jeans and the pickaxes to the folks that did mine the gold. So if they didn't strike gold, he still made money. And that's the position we want to be in. We want to maximize and we want to be exposed to the AI revolution, which I think is real. How do you value it? I don't know. But I do know there's some companies making money on it, and I want to have exposure there. Measured exposure, properly diversified. So if it doesn't turn out, once again, I keep coming back with the dot-com burst. I don't want to find myself in that situation. So we own companies like Microsoft. A little bit of NVIDIA, a little bit of AMD. A measured approach. We want to participate. We don't want all our eggs in one basket. Yes, sir. One second. Why don't we wait for the microphone so the folks at home can hear you?
If the Magnificent Seven come down to earth, not necessarily a major crash, what's that going to do to the S&P 500? What's that going to do to the indexes?
Great question. So we're talking about the Magnificent Seven right now, and now it's down to the Fantastic Four. It was the Fabulous Five a month ago, but we're talking about Apple, Microsoft, NVIDIA, Meta, Amazon, Google, and who am I missing? Tesla. So a couple different things can happen. It could be an orderly handoff. Right? I'm hoping it's an orderly handoff. I'm hoping that money flows from the 7 to the other 493 stocks in the market. Historically, there's not a very easy handoff, but it could happen. That could be the equity market's version of a soft landing. So I'm not sure if that's going to happen or not, but let's be honest. We have exposure to a good deal of the Magnificent Seven. We don't own Tesla for the most part in our portfolios. We own NVIDIA in one of our growth portfolios, but the other core have been long-term investments of ours. But what we've done is we've made sure to maintain our exposure. When they get too big, we trim. And one of the dangers that we might see going down the road, where you could see some big whiplashes in the market cap weighted indices are just that, right? The companies make up a larger percentage in the index, like the S&P 500, if those companies get bigger. And so we're seeing at one point in time, 7 companies make up about 30% of the S&P 500, 7 companies. There's 500 companies in the index, and 7 of them make up almost a third. And so when you have a little stumble, you can have some pretty volatile reaction in the market. So what would I like to see? I'd like to see those stocks do good continually, but then, spread the love. So all our stocks do well. Is that realistic? Historically, probably not.
So where does it land?
I don't know. No, we can all guess where does it land. We could have market corrections, but here's the brilliant part of how we manage money. Like I said before, and I apologize for hogging the microphone. No, none of my colleagues are surprised right now. So here's the deal. When we set up portfolios at Stonebridge, it's all about risk targeting and risk tolerance for our clients. We want to be set up that if we do have an unexpected pullback in the equity market, we're not forced to sell and run with the crowd. We have excess liquidity, or we rebalance from the fixed income side, where we get to take advantage of the market pullback. If someone's 100% invested in stocks and that's their plan, then we wait it out. But we don't allow systemic shocks to shake us out of good companies. There are a few ways to lose money, but there's one guaranteed way to lose money, and it's selling good companies when the market crashes. You got to make sure that you are set up, that you have your appropriate asset allocation. So if you do have an unexpected pullback, you don't sell when you're down. That's all I got. Any other questions? Okay.
So I always enjoy someone from the Federal Reserve, either current or former. My first question is, can I get a copy of the transcript translated in English? But anyway,
no, the answer is no.
there isn't one. You brought up a term, accumulated price pressure, inflation. And then you brought up the other example about the real income going up, wages 0.7% in January, all taken away by taxes. Mm-hmm. Where is the breaking point where the government entities finally figure out they're maxed out? It's the spending keeps going up, and they say, well, we're not raising taxes, Well, they're not raising the rates, but they're getting more on more income, and they're increasing other taxes. Where does the cumulative pressure come on government spending?
Well, first of all, the limit is your income. That's the limit. Just to give you a heads up. But seriously, well, the serious answer is that if you look at the income tax, the federal income tax, the rate is actually the categories, the income groups that are subject to a particular rate are inflation adjusted. And so when inflation goes up, it adjusts so that you're not paying a higher tax because you have more income. That may not be true of state income taxes, which probably isn't in most cases, and it's probably certainly not true of real estate is actually the other way. Property taxes go up when property values go up, generally. So the answer is there is a limit, but we certainly will never get there. The question is, in my mind, and this goes back a long way, I am not opposed to deficit spending. I am opposed to spending deficit or funding. I am opposed to spending deficit funding on basically things that are very short-term in nature. If I'm going to I basically think the federal government should separate their budget into a capital budget and an operating budget. And the capital budget is anything that you invest in that would actually help productivity, make the economy more efficient, and then have an operating budget, and the operating budget should balance, just like the states have to balance their budget, an operating budget. Make it balance. The problem with that is that people have a hard time trying to decide whether defense spending is an investment or spending, just a spending. And so the reason they don't do that is because of defense spending. But what I've always thought what you could do is you could separate defense. It's a separate item anyhow. You could have it as a separate item, have the budget as either a capital budget, an operating budget, and the operating budget has to balance. That way, if you're spending on near-term or short-term things, you're spending money that you can afford. Because if you can't raise the taxes to pay for it, you're not going to do it. So it would put some kind of a constraint on what you could do on the spending side. There are obviously limits, and if you go into a war, then that changes the picture completely. But anyhow, it seems to me that there are some things you could do. But I have a hard time with that. The other thing is, and you're going to hear about this probably in this year because this is an election year, but transfer receipts is a huge item from the government. And that's Social Security, that's Medicare, that's SSI. It's all those things that are associated with either Social Security or Medicare or Medicaid. And it's huge. It's huge. So how do you fund that? How do you pay for that? How do you say we're going to cut, or we're not going to cut, we're going to make it more difficult for you to get your Social Security benefits? I had an example. I'm hugging the mic now. Many years ago, they were talking about Social Security and how it was going to be bankrupt, and how do you fix Social Security? And I thought Social Security was pretty easy to fix at that time. That's all you had to tell people was, not everybody, just tell the people that were at maybe 10, 12, 15 years old, people who were just about ready to enter the labor force and just about ready to start paying Social Security taxes, tell them that they're not going to get any benefits until their full retirement age. You don't get any early benefits. You don't get any benefits until full retirement age. If you remember, Social Security, when it was set up, you didn't get benefits until 65. Life expectancy at the time was 62. You weren't expected to collect, right? And so now life expectancy is 70 something, and it's still, well, now they're raising it. But if you just tell the young ones that they're not going to get it. I did that. I told my 12-year-old grandson, I said, Nick, you're probably not going to get Social Security benefits until you're full retirement age. And you know what he said? Okay, Bumpa. I did my part.
Wrong.
Dan, we've known each other a long time, and you've, in many of these events, you have talked about a shock, a shock to the economy, and we can't foresee what the shock may be. Well, one of the shocks, and people obviously talk about the election and all those different short-term things, but one of the shocks, could it be that the Fed leaves interest rates higher for longer than any of us anticipate?
I think that's a very good chance that the Fed leaves rates higher for longer. Whether it will be shocking enough to derail the economy, that's not clear. It could, but it seems to me that there has to be something associated with rates being higher for longer that causes the shock. So some kind of financial shock. I don't think it's commercial property. Everybody is sort of aware of that. But what is it that's out there that would shock us? We have a series of shocks. It could be commercial property. It could be cryptocurrency. It could be a whole bunch of things that sort of implode at the same time that put a strain on financial markets. I'm sorry. I didn't mean to bring up crypto.
I think we might have had another question over here. Kati, right over here.
From the economic perspective, you mentioned Jerome Powell and the Fed board and the pressure to leave interest rates alone or increase them. And one thing, how concerned are you about the increase in political pressure, meaning what's good for one side or another side, and whether things should be done or not done?
The Fed has always been a political organization because it's in Washington. So it is subject to that kind of influence because of its location, the Federal Reserve Board. And the Board of Governors and the FOMC, they meet in Washington. So they get that kind of pressure. The Fed really does value its independence. It has independence from Congress in large part because it doesn't have to go to Congress every year to get funding. The Fed basically funds itself, or at least it used to. Now it loses money, which is interesting. That's another story. But they used to fund themselves, or they do fund themselves on the interest that they earn on the debt that they own. And so when they own $3 trillion of government debt and mortgage-backed securities, they're earning interest on those securities, and that's the revenue that they use to make any payments that they have to make, such as interest to banks on reserves and that kind of thing, and operating expenses. So they don't have to go to Congress for appropriations. So they're independent of Congress in that sense. They have no pressure coming or no connection to the White House other than the fact that maybe the president that's in office might have appointed the person that's in that chair, but that's not just, it's supposed to be 14-year terms, so you had to be a president for 2 terms to be able to appoint a majority of the Federal Reserve Board, supposedly. That's how it's set up. So it really is sort of independent in that sense as well. The dependence of the Fed is that the Fed wasn't established by the Constitution. The Federal Reserve Board was established by Congress. And if Congress wanted to, they could basically close the Fed down. And so the pressure that the Fed feels from time to time is more from Congress than it is from the White House. And what the Congress can do is the Congress could actually pass a law that says the Fed no longer exists. Now, who would be responsible for monetary policy if they did that? Then it would probably be Congress. Oh my God. So I don't think it'll ever happen because I think politicians love the idea of having someone to blame for everything. And the Fed is a good scapegoat for them. John?
Any more questions?
Well, thank you. Thank you.
So again, thank you everyone for coming. Clients, advisors, partners, future clients. From the bottom of my heart, thank you. It's a pleasure doing what we do, and we all enjoy our jobs. This is what we eat, sleep, and breathe, and you can tell we have a lot of fun doing it. And so thank you for the opportunity to continue to do it for you. And advisors, thank you for partnering with us. And we hope many, many good years to come. As you can see, our phrase is up here, let's go forth and conquer. Concluding this event for folks here, I believe we're going to have happy hour refreshments, hors d'oeuvres. And for folks at home, please don't hesitate to reach out to your relationship manager, your portfolio manager, if you have any additional comments or questions. And I think let's conclude. And again, thank you everyone for coming out, and let's go Twins.